So let us now move on to our next topic, which are derivative securities and basic option theory. So why do we spend time on this topic? The reason is simple. This is because derivative securities are now playing a more and more important role in financial markets. So what do we mean by derivatives? So a derivative is basically an investment whose value is itself determined by the value of some other underlying base asset. So if we think of derivatives in this way, we can also understand that derivatives are basically a contingent claims, right? Before we get into more realistic example, let's consider a made-up example. Suppose you and your friend make a bet with each other of rupees 10,000 that the bat with which Sachin Tendulkar scored his 100th Test century is going to sell for more than $1 million at a auction that is going to take place. So you are going to win 10,000 rupees from your friend if this bat actually sells for more than $1 million, and you're going to give your friend 10,000 rupees if the bat sells for less than $1 million, right? So this would be an example of a contingent claim or a derivative because the payoff from the bet to you is going to depend on the value of another asset, which is the bat here, right? So if the bat sells for more than 1 million, then you're going to win 10,000. But if the bat sells for less than 1 million, then you are going to lose 10,000, right? So this would be an example of a derivative. Now, to get to an example which is more closer to reality, consider a contract that states that one will make a cash payment to a wholesaler that is equal to the square of the price per barrel of oil on January 1 of next year. Now, this is also an example of a derivative or a contingent claim because the value of this contract is going to depend on another asset, right? So what is the other asset here? So this would be the value of oil at that particular date, right? So how much the amount of money that one is going to make to this wholesaler will depend on what the value of oil at that date is, and therefore the value of the contract at that date is an example of a contingent claim. Now, contingent claims are something that are not new to us. We have already studied one such example in great detail before in the class. So this was the example of car insurance, if you remember. Now, why was car insurance an example of a contingent claim? Because the value of having purchased that insurance is going to depend on whether or not the car suffered a damage or not, right? So if the car suffered a damage, then the insurance company is going to pay out some amount. If the car did not suffer a damage, then the insurance company is not going to pay out, right? So therefore, car insurance is an example of a contingent claim that depends on the value of another underlying asset, which here in this case is going to be the car, right? So this is the example that we studied. But now let's look at options. So what are options? Well, they are actually an example of derivatives. So you can look at information about options from different sources. So if, for example, if you go to the NSE website, so this is the National Stock Exchange, or if you go to the NASDAQ website, you will find information about options related to stocks of various companies, right? So in NSE, you can find out, for example, the value of different options that are being traded based on the stock price of Reliance. So this is another example from NASDAQ where we are looking at options related to the company's NVIDIA, for example. So this actually is just a snapshot, right? This is not the whole set of information. If you want to go to that website and check, you can find information there. So let's just understand what is in the snapshot, or let's just see what is in the snapshot for now. So, for example, this was taken at a particular point in November 2024 when price of a stock of NVIDIA was around 140. Okay, so at the point when this snapshot was taken, these were some of the options being traded for February 21, 2025, right? And you can see several things that are listed here that we want to understand, right? So you can see terms such as expiration dates. You can see terms such as strategies related to calls and puts. You can see near the money, these terms being listed. So various dates are listed. Bid and ask are listed. So you understand these terms from before. These are basically related to the price of the options. Then you have something called strike. And you can see that there are different numbers for calls and puts. So what we want to do now is to get into a bit more details about what do these terms mean? What does the term expiration date mean? What does the term call mean? Put mean? Um, what does the term strike mean, right? So in order to understand this, let us actually take a look at a table which is a bit cleaned up, but which has all these essential features. So we are now looking at stock options on Microsoft on that were available on September 10, 2021. Okay. This information is based on data from Yahoo Finance, which is another place where you can go to look at various options that are being traded for different stocks. So at the point where this information was collected, the underlying price of a stock of Microsoft was 295.71, and various options were available for trading on the stock of Microsoft. So these are some of those options that have been listed here. So you can see that compared to this, this has less information, but we just have kind of like compiled this information in order to make it easier for us to understand the various concepts. So let us see what is listed here. So you can see that from the perspective of September 10, 2021, there were several options that are listed here, which are expiration date after this period, right? So you can see that some of them have expiration date of October 1, others have a expiration date of December 17. The next column says that there are different values of strike. So these are strike prices. Okay. And you can see that, for example, the different rows here are this one, all of them are expiration dates with the same date, but you have got different strike prices, right? 290, 300, 310. Similarly, you have got from December the three options which have expiration date in December 17. They have a different again strike prices of 290, 300, 310. Then you have got two columns corresponding to call options and put options, and you have got some numbers which are listed here. So these are the basically the prices of the different options, right? So for example, the way you interpret this 9.43 is that what is the price on September 10, 2021 of a call option, okay, which has an expiration of 1 October 2021 and a strike price of 290. Okay. Similarly, this 15.28, if you were to understand it, it says that what is the price on September 10, 2021 of a put option which has an expiration date of 1 October 2021 and a strike price of 310. So the price of that particular put option is 15.28, right? So this is how you read the table. Okay. So we'll understand in more details what do these terms strike price, call option, put option, all these things mean. But notice several things at this point that for a particular expiration date, as the strike price is going up, the price of the call option is going down, and the price of the put option is actually going up, right? So, is this something that we would expect to see generally? Well, that's a question that we would be interested in understanding. Other questions that are of interest to us is, for example, are these price of call options and put options linked with each other somehow, right? Then again, another question that is often of interest is that if you compare the same strike price across two different options with different expiration dates, would you expect some sort of relationship to hold between the call option on with expiration date of October 1, 2021 and a strike price of 290 and a call option with the same strike price but with the expiration date of 17 December 2021, right? So again, some of the questions that are often important when it comes to financial trading. Okay, so what are these call options? Well, a call option gives its holder the right to purchase an asset for a specified price called the exercise or strike price on or before some specified expiration date. Now, this is a handful, right? So there are lots of things that are going on in this definition. So let us break it up one by one. So first, we are saying that there are different types of options, as you have seen here, call, put, or also from this larger table. So first thing that to notice is that we are now focusing on the definition of this particular type of option called the call option. The second thing to note is that we are seeing this definition from the perspective of someone who actually owns this option. Okay. So we'll see later on that there is another party to trading of this call option, namely the person who has written the call option or who has sold the call option. But here we are looking at the definition from the perspective of the person who owns the option. Okay. Now, it gives the holder or the owner of this option the right to purchase an asset. Okay. This is again, we'll see important later on, but for now, let's continue with this. So, this right to purchase is related to call. We'll see that another type of option will give you the right to sell, right? But for now, we are looking at call option. So, this is the right to purchase for a specified price, and the specified price is what is known as the exercise or the strike price. Okay. So this strike column that you are seeing here, so this refers to the price at which one can purchase the asset if one wishes to exercise this option. Okay. And finally, what is the expiration date? So this option, every option specifies what's the last date on which you can actually exercise this option. Okay. Now, why on or before? Because some options will have the feature, we'll see that you can only use those options on the particular expiration date, whereas other options have the feature that you can use it at any point on or before the expiration date. Okay. So now for this definition, we are keeping things general and we are saying that, okay, you can do it at on or before the date. Okay, now the first thing to note about option, and this also gives you a hint about why it is called option, is that it confers a right and not an obligation. Okay, so you will often hear this term. So what does that mean? So in order to make things concrete, let's look at a particular example. So suppose that we are looking at this second row here. So we are looking at an option which has an expiration date of 1 October 2021 and a strike price of 300. So we can see that the call option is selling for 3.60, right? But suppose you have purchased this call option, what does that mean? So what it means is that now you basically have a right to purchase a stock of Microsoft for a price of 300 at any time up to and including the expiration date. Okay. So where are we getting the 300? Well, we are getting the 300 because we are looking at the row corresponding to a strike price of 300, right? Why are we saying the expiration is 1 October 2021? Because again, this row is the one corresponding to an expiration date of 1 October 2021, right? So these are the significance of the first two entries in this row, and we are looking at the basically the call option, right? So this is the case that we are looking at. Okay. Now, what does it mean that it confers a right and not an obligation? So the sense that it gives you an option of purchasing if you want to purchase at a price of 300, right? It does not mean that you necessarily have to use this option, right? You can decide not to exercise this option as well, right? So in which case you would not be purchasing it. So, given that it gives you a right and not an obligation, the next question to ask naturally is that, okay, when will you actually use this option? Well, if you think about it, you are going to use the option only if Microsoft's share price exceeds this exercise price of 300, right? Why is that the case? So, suppose that at the time at which you are considering exercising this option, Microsoft's share price is 280. Would you want to exercise this call option? The answer is no. Why is that the case? Because if you exercise the option, you are spending 300 to purchase something which you could have purchased from the market at 280, right? So it doesn't make sense. What about if the price was 290? Well, again, it doesn't make sense because you are using this option to purchase something for 300 which you could have purchased for 290 on the market, right? But what happens if the Microsoft share price goes up to, let's say, 315? Then in that case it would make sense, right? Because if you go to the market and purchase it, you have to pay 315 to purchase one share. But if you are exercising this option, you could have purchased the same thing for 300, right? So therefore you end up making money if the share price is actually exceeding the exercise price, right? Okay, so if the stock price is greater than the exercise price on the expiration date, then the call value is going to be the difference between the stock price and the exercise price, right? So in the previous example that we just talked about, if you exercise it when the stock price is 315, then the call value at that point is going to be 15. Okay. What happens if the stock price is less than the exercise price? Do you still have to exercise it and make basically a loss? No, because then you would not exercise it, right? As we talked about, it makes more sense to purchase it directly from the market at 290 rather than exercising it, this call option, and purchasing it at a price of 300. If you do not exercise it, we are going to say that this call option expires without being used, and basically it is not worth anything at that point, right? Now, notice that there is a difference between the call value, which is this difference between the stock price and the exercise price if the stock price is greater, um, and the net profit on this call. And the difference is because you have to also pay amount of money to purchase it in the first place, right? So the net profit on this call is going to be the value of the option minus the price originally paid to purchase it. And the purchase price of the option is called the premium. So what is the price? So this is the final piece of information that was listed here for this call option, that if you were to purchase this option on September 10, 2021, you have to pay a price of 3.60, right? So when you're looking at the profit, or rather the net profit, then this would be equal to the value of the option, but you have to also subtract out the price that you pay to purchase it, right? So these are the different pieces of information that are there. Okay, so let's go back to the thing. So suppose that the October 1 expiration call on a share of Microsoft price with a strike price of 300 is selling on September 10 from 3.60. So we saw this already listed here. And suppose the price of stock on September 10 is 295.71. How do we know this? Because this was also, remember, listed here in the table, right? Where we said that the underlying price. So this is basically talking about what was the price of the stock and that date, right? So just to make sure we understand it, would it make sense to immediately exercise the option? The answer is no, right? Why wouldn't it make any sense to exercise the option immediately? Because remember, if you exercise the option at this point, you are basically getting to purchase a stock of Microsoft for a price of 300, right? Would you do it? No, because you could have actually just gone to the market and purchased it at a price of 295.71, right? So basically, if you exercise the option immediately, you're paying more for something that you could have got directly from the market, right? So if the shares continue to remain below 300 by the time the expiration date comes, then this call option would not be exercised and it would expire worthless. What happens if the share price rises to above 300 at expiration? Well, then in that case, it would be beneficial to exercise the option, right? So, for example, suppose that one share is selling for 301, then in that case, the call holder will exercise the right to pay 300 for a stock worth 301. Why is that the case? Well, something is available for the market in the market at 301. You can purchase it for 300. It makes sense to purchase it and for example, sell it in the market, right? Then you get value of which is equal to the difference, so that's equal to 1. Note that even though it makes sense to actually use up the option, given the price that you have paid for this call option, you would still end up making a loss, right? You would end up making a loss of 1 minus 3.60 or minus 2.60. Where are we getting this 3.60? Well, this was the price, right? Where are we getting this one? This is 301 minus 300, right? Okay, now you might think about that. In this case, why are we exercising this call option? Well, if you did not exercise the call option and you had already purchased the call option, if you do not exercise it, then you get a loss of minus 3.60, right? So by exercising it, you reduce the loss. So this at this point, the amount of money that you have paid is a sunk cost to you, right? So you are just thinking about how to kind of like reduce the loss. Okay. What happens if the price goes up above 303.60? Well, then you actually again will exercise it. And in this case, actually end up with a positive net profit, right? So for example, suppose the price is 305, you exercise it, then your net profit is going to be the value of the option. So the value is going to be the difference between the stock price, which is 305, minus the exercise price, which is 300. So that's equal to 5, minus the cost, which is 3.60. So therefore, you end up making a profit of 1.40, right? So anytime the stock price rises to more than 303.60, which is the exercise price plus the cost of the option, then you end up making a profit. Okay, now let's go back at this and now pay attention to the last entry, which was actually put, right? So what are put options? Well, put options are another type of options, right? And instead of giving the holder the right to purchase, this actually gives the holder the right to sell an asset for a specified price, which is again is called the exercise or strike price on or before the specified expiration date, right? So you notice that if you compare the definition of the put option and the call option, everything is almost the same, except for in the first case, you had the right to purchase. Here you have the right to sell the asset, right? So again, this is option, right? It's not an obligation to sell the asset, right? So, for example, if we go back to this table and again look at the same entry that we were looking for, which is this October 1, 2021 expiration date with a strike price of 300, we can see that the put option is selling for a price of 7.82. So, suppose one purchases this put option, what does that entail one to do? Well, it gives one the option of selling a stock of Microsoft for a price of 300 at any time up to and including the expiration date. So you can think about the exact way in which we reasoned about when would it make sense to exercise or use up this option. And the answer is going to be that in this case, this option is going to be exercised only if the price of the underlying asset is less than the exercise price, right? Why is this the case? So imagine that you have basically price of Microsoft at the last date as 305, right? At this point, would you want to exercise this option? The answer is no, right? Because if you have a stock that you can sell, then it's better to sell it at the market for a price of 305 rather than to use this option and sell it for a price of 300, right? So if the price is more than the exercise price, it would not make sense to exercise this put option. But what happens if the price of Microsoft becomes 292? Well, at this point, what you can do is you can go to the market, uh, purchase a stock of Microsoft for 292. And if you own the option, you then actually exercise this option and then you sell it at a price of 300, right? So you end up making a profit of 8 on this thing. Of course, profit is not the correct word because in order to calculate the actual profit, you should also take into account the cost of actually having purchased the option at the first place, right? But before we get into that, one thing to note is that in comparison to the call option, whose value increases when the asset price rises, the profits on the put option actually increase when the asset price falls, right? So again, going back to this example, if the price falls down to 260, you pocket even more of a money, right? Because you can then purchase it for 260 and then sell it for 300 if you actually own this option. So you can just go and think about the different numbers, and you can see that your profit is going to increase as the price of the stock keeps on falling. Okay, so again, going to that table just to make sure that we have understood this. So again, we are looking at October 1, 2021 strike price of 300. We are looking at a put option. So this was selling for 7.82. Suppose that we are thinking about whether we want to exercise this option on September 10. So the price of stock at that point is 295.71. Again, this is information that is listed here in the table as well. And if you buy a share and immediately exercise the right to sell it at 300, then you end up getting 4.29 from this transaction, right? Why will you do it? Because you are purchasing something from 295.71 and you are selling it at 300, right? So you end up getting 4.29 from this transaction. However, you'll still be making an overall negative profit, right? Because the price, remember, was 7.82. So your net profit is 4.29 minus 7.82. So at this point, you might want to wait, especially if you think that the price is going to fall even more. So suppose that you anticipate that the price on September 30 is going to be 285. Then if you actually wait from September 10 to September 30, then you end up actually getting a positive net profit, right? Because at that point you will basically get 15 from purchasing one from the market at 285 and selling it for 300, and then you will be able to recover this 7.82, for example, right? So then you have to think about, okay, even though you are making a positive amount from this transaction, exactly how do you kind of like think about uh, deciding when to exercise this option, right? Okay, so far we have been looking at the definition from the perspective of somebody who owns the option. But whenever there is trading in options, there are actually two parties that are involved, right? So one party is the one that we have been looking at so far, which is the one who owns the option or who has purchased the option. But there's also going to be a counterparty to this trade, namely that there needs to be somebody who is selling the option, right? So when we are thinking of the sellers of call options who are set to, by the way, write the calls. We can also think about the trade from their perspective as well. So if you think about the example that we studied so far, the sellers of the call options are going to receive the premium income. So remember, premium is this is something that we defined before. This is the purchase price of the option. So from the seller's perspective, this is the amount of money that they actually get as payment now, right? But of course, when they sell it, they also have to consider the possibility that at some point they'll be required to deliver an asset in return for an exercise price which is less than the market price, right? So, for example, the stock price becomes actually 310 on October 1, and the call option owner exercises this option. Then the person who has sold the call option has to go out in the market and purchase something for 310 and then has to sell it for 300, right? So from the seller's perspective, if somebody actually invokes the option, this is no longer something that it is optional for them to actually say, okay, we are going to deliver, not going to deliver. If you have already sold the call option and somebody exercises this option, then it is obligatory for you to actually go and meet the requirements of the trade, right? Okay. Now, if the option is left to expire worthless, then the profit is pretty simple. It's basically the premium that was collected. If the profit was actually used, sorry, if the option was actually used, then you have to kind of like be a bit more careful in calculating. So we'll look at these expressions in more details in a more general case for a call option later on. Okay. Okay, so some more terms that are frequently used that one should be familiar with. So we are going to say that option is in the money when its exercise would produce a positive cash flow, right? So in the context of discussion that we have had so far, a call option is going to be in the money when the asset price is going to be greater than the exercise price. And a put option is going to be in the money when the asset price is less than the exercise price, right? So again, if this is not clear, go back to the discussion that we have had and then see that why this is the case. Okay. Options are going to be at the money when the exercise price and asset price are equal, and options are going to be out of the money if when the option is exercised, it is going to produce a negative cash flow, right? Now, of course, you do know that this is if this was the case, then it wouldn't make sense to actually uh, exercise the option. But suppose somebody does exercise the option at a particular point of time and finds a negative cash flow, then at that point they're out of the money. So where is this used? Basically, you can actually go back to this table, for example, um, sorry, this table, for example, and think about, okay, uh, is this particular option in the money or out of the money given the underlying price now and the strike price and all these details that are available, right? So that can be a way of classifying the different options depending on the market conditions at that time. Okay, so some more pieces of terminology. Now, we have so far been saying that you can exercise the option on or before the expiration date. So an option which has that feature is what is known as an American option, right? So that allows the holder to exercise the right to purchase if it's a call option or sell if it's a put option, the underlying price on or before the expiration date. However, there are some options which do not have that flexibility and they only allow you to trade on the expiration date. So these are what are known as European options, which allow you to exercise the option only on the expiration date, right? So compared to that, you can see that American options are more flexible because you can exercise it at a point before the expiration date as well. And that is what in general makes them more valuable than European options as well. Finally, we have so far been talking about options on stocks, but you can have other types of options as well. So these are some of the other options that can be traded that are listed here. So index options, for instance, are call or put options on a stock market index rather than one particular stock. So there are different types of index options that are available for Sensex, Nifty, S&P 500 or Nasdaq 100, or there are these other ones that are more international as well. You can also have foreign currency options. So this would be a situation where you have the right to buy or sell a specified quantity of foreign currency for a specific number of rupees now. And finally, we also have something called future options, which gives the holders the right to buy or sell a specified futures contract. So we'll be looking at some of the details of these sort of options later on. But first, our task for this week is going to be understanding in more details about how are these values of these different options that are available, what are the strategies that you can implement using these different options, and also try and make some sense in thinking about how to think about the prices of the different options that we have seen so far. Like to go back to some of the questions, can we systematically say what's the link between call and price options? Can we think about what is the relationship between the price of different options with different uh, exercise dates or different strike prices, right? So we need to understand a bit more before we get into these more complex options that we have listed here.